So I stopped drinking coffee in the morning before trading because I noticed that it was not helping my heart rate to stay stable and to kind of keep a calm equilibrium. And I noticed a big difference the last few days actually. Hey guys, what's happening? Hope you're well today. Welcome to the YouTube video. So in today's video, we're going to be discussing a few interesting topics, mainly talking about human tendencies and how they play into the market, basically how the market plays into the human tendencies. Now, by human tendencies, I mean things that we do naturally that make us bad traders. All right, so let's get into this. Hit the like button, subscribe to the channel if you have not already, and let's get to the video. All right, cool. So there was a couple of interesting videos I watched recently. One of them was on a YouTube channel called Fractal Flow. He was talking about something in his video that has to do with manipulation of the market. Manipulation is very common practice. Now, whoever has the control of the game has the ability to manipulate it as they see fit. What we're going to talk about first is this thing, which is called the von Restorff effect. When you're presented with a series of images and there's something that stands out from the series of images, our brain naturally focuses in on the things that stand out. So if I can give a direct analogy to trading, it's when you're looking at a price chart. If there's an anomaly on your price chart, your brain will naturally focus on that anomaly. All right, so then how does this play into trading even more? Well, because this is a natural human tendency, you need to actually think in order to negate this. So if you don't think, if you get to a point where you're tired or something and you just stop thinking, then you're not going to be able to negate that natural tendency of you always focusing on super obvious, right? So if you see buyers in the tape, you buy. If you see sellers in the tape, you sell. Where do you put your stop? Right under the lows, right above the highs. It's an important concept to understand. So when I look at a price chart, okay, I can see a number of highs and lows on this price chart. Based on the structure of the market and what I just finished saying about obvious things standing out, there might be a higher probability that when there are anomalies that stand out or obvious things, and this ties into candlestick patterns too, when there are obvious things on a chart, they are more likely to get tested than not tested. So when I'm saying things that are obvious, I'm talking about obvious lows, obvious highs, and candlestick patterns that everybody learns when they start trading, like bullish engulfing and hammers. When people see a huge upper wick or lower wick, they automatically think that I'm gonna buy and put my stop right under that low. And especially on the short-term time frames, I've seen this fail so many times over and over again. Just some food for thought for you guys. Think about starting to pay attention to things like that. A general rule of thumb is that market professionals, they know that this is a human tendency, so they're definitely going to play into it to some degree or another. So again, avoiding the obvious. That's easier said than done, because sometimes when you're in a trade, you might not necessarily know that you're going to be the sucker in the trade. And actually a buddy of mine made an interesting tweet and he said, if you're in a trade and you don't know who's gonna get fucked, then it's probably you. Just some food for thought. All right, let's move on here. All right, so take a look at this chart right here. We've got why traders fail. All right, so many factors as to why traders fail. But whatever the factors are, they're always going to be triggering these human tendencies right here. So let's go over these human tendencies. So why traders fail, there's a number of reasons why traders make mistakes. We don't have to go into that right now, but I want to talk about the tendencies that they trigger and how you can think about these tendencies more so that you can potentially program yourself to avoid getting into this in the future. So a natural human tendency is to be risk averse with winners, meaning that when you're up on the day, you're more comfortable taking the profit and stopping, when in reality, when you're in a winning position and when you're doing well, you should probably continue. So that's a fallacy. And then let's keep going here. So risk taking with losers. Humans are naturally risk taking when we're in a losing position because we're obsessed with the idea of the fact that we can make our money back really quickly, which entices us to gamble. And we'll talk about this as the video continues here. So those are the first two tendencies: risk averse with winners and risk taking when it comes to being in a losing position. The next one is we tend to focus on the obvious naturally. And like we just said, the von Restorff effect. So if you show someone a chart with an anomaly on it, they're naturally going to focus on the anomaly. They're going to say, all right, are you going to go short or long? Where are you going to put your stop? And if they don't think actively about how the majority of humans tend to think the same way and focus on things that are obvious, then they're going to end up putting their stop in an obvious place too. And the next thing is basically just gambler's fallacy. When you've lost perception of the probabilities of the environment that you're in. Okay, so you've become a gambler only when you've lost your sense of probability. The last thing about the gambler's fallacy, this happened to me many times, is that when you're in a position of a loss, you're less inclined to take a favorable settlement because of how you sat there sitting in a painful position. Now some part of you is seeking a reward for that pain you experienced. Okay, all of this is a gambler's fallacy. Fine. All right, are you guys still with me here? Let's keep going. The market's purpose is to exploit human tendencies. So human tendencies, like we just discussed, holding on to losers too long and cutting winners short. How often does it happen when you get into a losing position and you end up becoming a bag holder? How often does it happen that that bag holder just gets worse and worse and worse until you finally decide that you made a big mistake and you need to cut it? Why do you think that happens? Because you're not the only one being a bag holder in that scenario, because it's a human tendency and many people were enticed into being bag holders in that situation. Okay, so this one goes a little deeper. Human programming reinforces human tendencies. Without going too deep on this, everything you're exposed to on a daily basis, let it be social media, news media, your parents, your best friend, or anybody you come into contact with, everybody is exposed to the same sort of programs that we all are. Okay, therefore we reinforce these programs. Now I'm going to put a slight emphasis on social media and news media because these are the two biggest things that fuel the ego. The human ego, as you know or might not know, is a horrible risk manager because the human ego thinks that the world owes it something. So at this point, it's become pretty clear to me why the majority of humans are horrible risk managers. We're going to move on and talk about these bad trading habits that many of us have been a product of. And there was this one video I watched from Brett Steenbarger. He's a very smart man. There was one video I really enjoyed from him where he's talking about bad trading habits. It's a 3-minute video. Go watch it. I'm going to kind of paraphrase what he said in the video. It's sort of a visualization exercise that he gives about how to set yourself up to avoid entering that state of mind where you're exercising bad trading habits. Here we go. Try to remember every big loss in trading. The low emotional feeling of being broken, on the verge of giving up and whimpering in the corner. I felt that, and if you haven't felt that, you're in for it. That is you as a product of those tendencies that took control of you, that you allowed to take control of you because they felt natural. Guess what? Because they are natural. They're programmed in you on such a deep level. These human tendencies contribute to the negative behavior in your decision making in your everyday life. Now visualize these tendencies in the outside world around you. More specifically, visualize a person that you don't like. At this point, you're kind of separating these negative tendencies from you, and you're trying to visualize them next to you, like the evil demon sitting on your shoulder trying to tempt you to do something bad that you shouldn't do. That person that you're visualizing, it could be a person that you don't like or a person that you know is a bad influence on you. So now you've made a clear visualization. So let's talk about being in the position of a loss, because this is the hardest thing in trading, by the way. When you are in a position of loss, you must train yourself to see the evil demon trying to suck you in. You must resist the demon because you know that this doorway leads to every collective negative experience you can recall. For some, that may lead to their utter demise. The human ego plays a big role in the programs we're exposed to. Like I just said before, internet, social media, news media, they all succeed in fueling your ego. The human ego is emotional, it's a gambler, and it only views the world from its own perspective. Therefore, it's a horrible risk manager. All right, let's move on here. I'm going to conclude what I think is the true definition of a gambler. Past the true definition. A person is called a gambler when it appears that they have a false understanding of probability. Gamblers overweigh improbable outcomes because the positive thought overweighs the high probability of a loss. You become emotionally attached to the idea of something really good happening. That's why people buy lottery tickets. And it works the same for a loss. This fuels the gambler's fallacy because you become fixated and emotionally attached to the prize. Any outcomes close to the one you expect will trigger someone to develop a false view of the probabilities. Trading an edge isn't gambling if your expected return is positive. But trading is gambling fundamentally because you are sitting there putting on bets. So I'm going to finish by saying a person becomes a gambler when they lose the ability to assess probability. Let's just conclude the ideas from this video. So first we start off with the Van Restorff effect, which is the idea that humans generally tend to focus on the obvious, which means that they will most likely be taking trades with stops and obvious levels. The human ego is emotional, and everything around you on a daily basis is fueling your ego. Your ego doesn't understand probability. Your ego only understands emotions and the feelings associated with big losses and big wins. Your ego is associating emotions to events in the real world. The small probability of a big win sounds amazing to the majority of people. That is completely false. The idea of a huge loss is emotionally disturbing. Therefore, you will do anything to prevent a huge loss, even if the probability of the huge loss is 0.01. So that leads me to conclude that the true definition of a gambler is when a person loses the ability to assess probability because their emotions have taken control of their decision making. And this doesn't only apply to trading. All right, guys, we're going to leave it there for today. All the best, and I'll catch you in the next video. Take care. Bye.